bouncing back to Alan, do you see institutional investors shifting their attention to any particular areas as a result of the crisis, or are they being tight-fisted in this environment? And how is that different from what retail investors might be doing right now?
In the institutional world, I think there's definitely been a shift in attention in a few different ways. So many of these institutions that were previously active in the market are facing margin call issues today. So ultimately, the way that world is set up is you've got, for example, private funded capital that's gone out and raised $250 million. They've gone to a warehouse lender and borrowed another $750 million against that, and now they have $1 billion of buying power. Those facilities, those warehouses, oftentimes are structured as repo facilities or other types of facilities that ultimately have mark-to-market features. So what's happened in today's environment is that those warehouse lenders are marking these loans down and ultimately calling on those borrowers, those funds, to post margin calls. So these funds need to create liquidity. So what's happening is they're going into their portfolios, they're picking pools of loans, and they're going to the secondary market to sell. Ultimately, what you have is institutional investors that need liquidity, and on the other side, you have institutional investors that perhaps have liquidity and are looking for an opportunistic purchase. And you're seeing the secondary side of the market pick up for that. So you're seeing discounted trades and more opportunistic deals happening, executing anywhere from 75 to 96, 97 cents on the dollar. What's not happening, though, is you're not seeing a ton of new par purchases, and you're also seeing more tight-fistedness around what I call the in-betweeners. So basically loans that were originated from February to middle of March, pre-COVID-19, those loans right now don't really have a home unless somebody's looking to sell them at a discount. But we are seeing capital open back up for post-COVID-19 valuation-adjusted loans, where lenders are now coming back to the market, continuing to lend, but they've brought their LTVs down 5 to 10 points, they've implemented interest reserves, etc. Separate from that, I have not seen directly, but I have heard through the grapevine that there are some lenders out there, mostly consumer-based lenders, that are focusing on loans to people in the medical profession. They seem to believe that those borrowers are somewhat insulated from what's happening in the market right now because of the obvious need for medical professionals. But other than that, we haven't seen many other shifts. And as far as retail investors, it's actually interesting. So one of the questions we got all the time as we were building our business is, what happens in a downturn? What happens to your capital sources? And our response to them has always been, well, we're not beholden to a single capital source. We've always done a pretty good job at Sharestates at diversifying your capital sources. So up until recently, we've had about a 70-30 split. About 70% of our capital has historically been coming from whole loan institutional investors, which were comprised of private equity groups, hedge funds, asset managers, insurance companies, etc. And 30% of our capital has come from the syndication or crowdfunding side of our business, which includes retail investors, those are accredited investors, high net worth individuals, and then smaller unlevered institutions. And sure enough, what we expected in this type of a scenario has kind of proven itself out, which is the levered capital, the institutional capital, has had to push pause, and the unlevered retail investor, who we've long kind of theorized would be stickier capital, has stuck around. So we're continuing to see investments from the crowd coming through the marketplace side. Granted, it's a bit diminished, but it's still there.